All right, let's dive into this. The Bogleheads Guide to Investing. We're talking long-term wealth building. And even if you think you know the Bogleheads, this book, there's so much in here for everyone.
True. The thing about the Boglehead approach, it boils down to simplicity, common sense, stuff that gets lost sometimes in all the financial noise out there.
Yeah, for sure. One of the things that really hit me was the book's focus on fees and how they impact your returns. Small percentages, but over time, wow.
That's huge, yeah. Even just a 1% difference in fees, think about that compounding over decades. You're losing out on serious potential growth.
They use a great example, right? Comparing two investors, one goes with low-cost index funds, the other picks higher-cost, actively managed funds.
Exactly. Let's say you start with $100,000, average return of 7%. After 30 years, the low-cost investor has almost double, just from that fee difference.
Wow, that's powerful. It makes you think twice about those fees, right? Like they're silently eating away at your returns.
It's a lesson we often miss. We're all chasing higher returns, but those costs, over the long term, that's where the real impact is.
And the Bogleheads, they're not convinced that those higher returns are even that easy to get. They really challenge the idea of beating the market.
It's tough. Consistently outperforming the market, it's super difficult. Even for the pros, with all the resources, it's not easy.
They even compare it to roulette. Like you might win a few times, but over time, the house always wins.
Powerful analogy. And it's true, statistically. Active funds beating benchmarks consistently, it's rare.
So it's more about accepting market returns, minimizing costs, and that's where the index funds come in, right?
Exactly. You're tracking an index, like the S&P 500. You're buying a tiny slice of the entire market.
And because they're not actively picking stocks or trying to time things, the fees are super low.
Right. Those fees, even if they seem small, over time, they make a big difference.
They give that example comparing an S&P 500 index fund to the average active fund, right?
Yeah.
Over 10 years.
Yeah, the index fund, around 8% return per year, average active funds 6%. That 2% difference. With compounding, it's massive in the end.
Wow, those percentages really add up. And tax efficiency, that's another big thing with index funds.
Right, less turnover means fewer taxable gains. Makes a difference, especially in a taxable account.
So low costs, simple, tax efficient, sounds great. But I'm sure some people are thinking, wait, I can do better than just average returns.
It's tempting to think that way, but the evidence shows it's tough to beat the market consistently.
The Bogleheads make that point pretty clear, don't they?
They do. They say, why take the risk and pay more in fees when you can just capture the market return?
Okay, I'm starting to get it. But how do you actually put together a portfolio with index funds? That can feel overwhelming.
The Bogleheads keep it simple. It starts with figuring out your asset allocation.
So how much you put into stocks, bonds, all that stuff.
Exactly. It depends on your risk tolerance, how long you're investing for, your goals. Younger investor, maybe more in stocks for growth. Someone closer to retirement might want more bonds, a bit more conservative.
Makes sense. The book even has some sample portfolios, right? For
Yeah.
different situations.
Yep, for young investors, those approaching retirement, retirees, etc., they're just starting points. Got to adjust for your own situation.
Right. It's not one size fits all. But having those examples helps. And rebalancing, that's important too, right?
Super important. Keeps your portfolio aligned with your goals. Over time, some investments do better than others. Things can drift off track.
So if my stocks do great and they suddenly make up way more of my portfolio than I planned, I'd sell some and buy more bonds to rebalance.
Exactly. It can feel weird to sell what's doing well, but rebalancing keeps you on track, manages risk.
You're sticking to the plan, not letting your emotions take over. That seems to be a big part of the Boglehead approach.
Absolutely. And we'll talk more about managing emotions, plus some other great stuff from the book in the next part.
This is great stuff. Can't wait to dig in further next time.
Looking forward to it.
Back again for more on the Bogleheads Guide to Investing. We laid the groundwork, got our financial houses in order. Now, where do we put our money?
Time to talk index funds, the core of the Boglehead philosophy, and for a good reason.
I used to think index funds were, well, kind of boring, like just tracking the market. Where's the excitement in average returns?
It's funny, right? But the thing is, matching the market, index funds, they often outperform a lot of those fancy, actively managed funds over the long haul.
Yeah, the book digs into that, doesn't it?
Yeah.
Challenges that whole beat the market mindset.
Yeah, trying to predict which stocks or sectors are going to win, it's almost impossible to do consistently. Even for the pros, they have a hard time.
They have that roulette analogy. You might get lucky a few times, but the house always wins in the end.
It's such a good visual. And the data supports it. Most actively managed funds don't beat their benchmarks, not in the long run.
So instead of trying to be smarter than the market, Bogleheads say accept the market returns, keep costs low, and that's where index funds shine.
Exactly. Index funds just track an index, like the S&P 500. It's like buying a piece of the whole market.
And since they're not actively trading and trying to time the market, the fees stay really low.
Low cost, huge advantage. The book shows how those seemingly small fees, they add up over time, eat into your returns.
They have that comparison, don't they? Low cost S&P 500 index fund versus the average actively managed fund over 10 years.
Yeah. Index fund, about 8% a year. Active fund, 6%. That 2% difference with compounding, it's a huge gap in the end.
It's crazy how much difference those little percentages make over time. Plus, index funds are more tax efficient too, right?
Absolutely. Lower turnover, fewer taxable gains. Something to think about, especially in a taxable account.
So we've got low cost, simplicity, tax efficiency. Seems like a no-brainer. But I'm sure some people still have doubts, like, are you just settling for average returns with index funds?
It's a common concern. People think they can do better by picking individual stocks or going with an active manager.
Yeah, that beat the market idea again. What do the Bogleheads say about that?
They acknowledge, sure, some people outperform in a given year, but doing it consistently year after year, it's really tough, even for the experts.
And they've got data to back that up.
Tons of it. Active funds that consistently outperform. Very few. And even the ones that do well one year might underperform the next. It's unpredictable.
So they're saying, why take the risk, pay those higher fees, when you can capture the market return with a low-cost index fund?
That's the gist of it. They believe that for most people, passive investing is the way to go. Lower risk, more effective for long-term wealth.
Okay, I'm on board. But how do you actually put together a portfolio using these index funds? That's where it can get a little tricky.
Well, the Bogleheads keep it pretty straightforward. You start with asset allocation.
Which is just deciding how much goes in stocks, bonds, all that.
Yep. Depends on your risk tolerance, your time horizon, your goals. Younger investor, maybe more in stocks for growth. Someone nearing retirement, maybe more bonds, a bit more conservative.
Makes sense. And the book actually has some sample portfolios, right? Like for different types of investors.
Right. They have portfolios for young investors, those closer to retirement, retirees, different scenarios. They're meant to be starting points. You'd adjust them to fit your own needs.
Not one size fits all. You got to personalize it. But having those examples is helpful. Oh, and rebalancing. That's something they emphasize too. Why is that so important?
Rebalancing, make sure your portfolio stays aligned with your goals. As time passes, some investments will do better than others. Your asset allocation can drift.
So say my stocks have a great year. They suddenly make up more of my portfolio than I planned. I'd sell some and buy more bonds to get things back in balance.
That's it. It feels odd sometimes selling what's doing well, but rebalancing is about maintaining your strategy, managing risk.
It's about sticking to the plan, not letting emotions take over. That seems to be a theme in the Boglehead approach.
Definitely. We'll delve more into that, along with some other insights from the book, in the next part.
All right, welcome back. We've covered so much in our deep dive into the Boglehead's guide to investing, low costs, index funds, rebalancing.
But there's always more to learn, right?
Oh, absolutely.
Yeah.
And you know what I like? This book doesn't shy away from some of the trickier stuff, like bond durations.
Yeah, I'll admit, bond duration, that's always been a bit of a head-scratcher for me. What is it exactly, and why should I care?
Good question. It's actually simpler than it sounds. Duration basically tells you how sensitive a bond is to changes in interest rates.
Yeah.
Think of it like a seesaw. A bond with a longer duration, it's way out on the seesaw, bigger swings up or down when rates change.
Okay, I see. So if I think rates are going to rise, I'd want bonds with shorter durations to minimize the impact on my portfolio. Exactly. The Bogleheads Guide says understanding duration can help you choose bond funds that are a good fit for what you think is going to happen with interest rates.
So it's about being strategic, not just buying any old bond index fund. And speaking of bond funds, the book talks about high-yield bond funds. Aren't higher yields better? That's what it seems like.
Well, higher yields, sure, they sound great, but there's a trade-off. High-yield bonds, they come from companies with lower credit ratings, more risk involved.
Ah, the risk-reward thing. You might get higher returns, but there's also a higher chance the company could default on their debt. Is that why the Bogleheads tend to recommend sticking with those more traditional bond funds, the investment-grade ones?
Yep, it all goes back to minimizing risk. That's their main focus. Plus, high-yield bonds, they act more like stocks anyway, so they don't really give you that diversification you want from bonds.
Interesting. So it's not just about chasing the highest yield, it's about understanding the risks and how those different bonds fit into your overall plan. Oh, and taxes. The book goes into some of the tax stuff with investing, which I bet a lot of people don't even consider.
For sure, taxes can really make a dent in your returns. The Bogleheads have some great tips on how to minimize that impact.
They talk about something called unrealized gains, which kind of blew my mind. You mean you can owe taxes on profits you haven't even taken out yet?
Yep. If a mutual fund has big unrealized gains, those can get passed along to shareholders as capital gains distributions, even if you're just holding on to the fund.
So even if you're holding for the long term, you could get hit with a tax bill. Doesn't seem quite right.
It can be a bit of a surprise. That's why the Bogleheads say to be aware of the tax implications of your funds, especially in a taxable account. They suggest looking into tax-managed funds. Those are designed to keep those taxable distributions lower.
Tax-managed funds, what are those exactly?
They generally have lower turnover, meaning they don't trade stocks as often. That keeps the capital gains down. They might also use strategies like selling off losing positions to offset gains to lower the tax hit.
So they're like index funds, but even smarter about taxes.
You could say that. If you want to stay passive and keep your taxes down, tax-managed funds are a great option.
It's amazing how much goes into building a really solid Boglehead portfolio. It's not just about picking investments and hoping for the best. There's a lot to think about.
Absolutely. And the Bogleheads Guide goes even further. Saving for college, what to do with a sudden influx of money, estate planning. It covers a lot of ground.
It's really a one-stop shop for building a strong financial future. So as we wrap up our deep dive, what are some of the key takeaways you hope our listeners will remember?
The big one, I think, is that building wealth takes time. The Bogleheads, they're all about making smart decisions, keeping costs low, spreading your investments around, and most importantly, being patient, focusing on those long-term goals.
It's that whole idea of slow and steady wins the race.
That's it. And it's never too early or too late to start getting your finances in order, making a plan. The Bogleheads Guide to Investing gives you the tools to take control and reach your goals.
It's been a fascinating look into the world of the Bogleheads. Their approach to investing, it's simple, it's powerful, it puts you in the driver's seat. So if you're ready to start your journey to financial freedom, check out the Bogleheads Guide to Investing. It might just change your life. Until next time, keep those minds sharp and keep on learning.